Internal Revenue Service IRS tax news. IRS issues proposed regulations for TCJA's simplified tax accounting rules for small businesses. IR 2020-174, July 30th, 2020, Washington. The Internal Revenue Service today issued proposed regulations. Link to those proposed regulations here. Updating various tax accounting regulations to adopt the simplified tax accounting rules for small businesses under the Tax Cut and Jobs Act, TCJA. For tax years beginning in 2019 and 2020, these simplified tax accounting rules apply for taxpayers having inflation-adjusted average annual gross receipts of $26 million or less, known as gross receipts tests. Taxpayers classified as tax shelters cannot use the simplified rules even if they would meet the gross receipts test. Prior to the TCJA, certain taxpayers could determine whether they were eligible to figure taxable income under the cash method of accounting by meeting a different gross receipts test. That gross receipts test was met if the taxpayer's average annual gross receipts for all prior taxable years did not exceed $5 million. After the TCJA, a taxpayer meets the gross receipts test and can use the cash method if average annual gross receipts for 3 taxable year period ending immediately before the current taxable year are $25 million adjusted for inflation or less. So they're saying here cash method versus accrual method. Cash method typically being an easier method to use because you can kind of track the cash. You can use the cash flow as the point in time when you're going to be recognizing the revenue and expenses. However, the cash method has some ability to be distorted in some ways because obviously if you're using cash to determine when revenue and expenses are incurred, then adjusting the cash flow to some degree may adjust, the revenue recognition could distort revenue recognition to some degree and distort taxes. So the IRS wants to use a cash method when possible, or allow the cash method to be used because it's typically an easier process. It's also nice for auditing to some degree because they can monitor the cash flows if they had to go and get evidence on some kind of transaction. But they're also skeptical of it to some degree in certain cases, especially when the revenue gets over a certain point or when there's a substantial amount of inventory involved, which could kind of distort the cash flow method. So these are rules for the cash flow method. Again, it's generally thought to be kind of an easier method to use, but if you're not meeting some of these limitations, then you will typically need to use the possibly more complex but maybe more accurate, accrual type of accounting method. Back to the text. The TCJA also exempted taxpayers meeting the gross receipts test from the uniform capitalization rules. Tax reform also added an exemption to the requirement to use an inventory method if their inventory is treated as non-incidental materials and supplies or accordance with the applicable financial statements, AFS. If they do not have an AFS, taxpayers can use their books and records. The proposed regulations issued today implement these statutory changes and provide clarifying definitions. The proposed regulations issued today also provide guidance for small businesses with long-term construction contracts and the requirements for exemption from the percentage of completion method and the uniform capitalization rules. For taxpayers with income and long-term contracts reported under the percentage of completion method, guidance is provided for applying the look-back method after the repeal of the corporate alternative minimum tax and enactment of the base erosion and anti-abuse tax, BEAT. For more information about this and other TCJA provisions, visit irs.gov/tax reform. There's a link to that here. There'll be a link to this in the description.